After initial recognition, an entity can choose to either recognize property, plant, equipment at cost or under the revaluation model. Truthfully, in practice, we rarely see entities other than government entities elect to use the revaluation option, primarily because of ongoing compliance obligations. And those obligations relate to revaluations on a regular basis to make sure that the carrying value of those assets reasonably approximate fair value. When an entity does choose to do the revaluation option, an entire class of assets needs to be revalued at sufficient regularity. When there's an increase in fair value for those assets, the increase is applied against that class of property, plant, and equipment. When a revaluation is performed and there's an increase in the underlying value of the property, plant, and equipment, there's an increase in the PP&E and equally an increase in a reserve within equity, commonly called the revaluation reserve. If subsequently, in future periods, that value decreases, you would first apply that decrease against that class's asset revaluation reserve. If there's not sufficient capacity within that reserve, any further decreases would go within the P&L as an impairment expense. In any given year, depreciation expense is calculated based on the fair value of that asset at the start of the year, as opposed to at the end of the year when companies typically perform their revaluations.